Want to be sure you're getting the most out of your retirement for all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now here's Jim with this week's Dollars and Cents tip.
And this week's message is really focused on if you're in your 60s particularly, and you've got large retirement account balances. You know, when you turn 70 and a half, you've got to start taking out required minimum distributions. And one of the things that we've talked about this show on this show in the past is, you know, what are taxes likely to look like in the future? I think more than likely, if you're looking down, I don't mean just 1 or 2 years, I mean 5, 10 years. You know, most of you that I talk to on a week in, week out basis believe taxes are going to go up. And when you get to age 70 and a half and you're taking large chunks of money out of your retirement accounts, because if they're large balances, you know, that's all going to show up on your income tax return. So what can you be doing in the meantime? I'm a big believer that you look at your overall income and the concept, especially with large retirement account balances, that if you're not 70 and a half yet, that you consider filling up your tax bracket. So here's what that means. As an example, if you're married filing jointly in 2012, for the 2012 tax year you're going to file next spring, the 25% tax bracket kicks in at a little over $70,000. So let's say you're looking at your income and you're retired, and let's say it's around $55,000. You've got an extra $15,000 you can fill up in that bracket at a 15% bracket before it jumps up to 25. And if you have large retirement account balances, when you're in your 70s, it's going to bump you well into that bracket, plus tax brackets may be higher. So fill up that tax bracket. Maybe go ahead and start, or at least consider taking more out of your retirement accounts to fill up that bracket at 15% and reinvest that where you don't have to deal with that tax burden of accumulating these tax time bombs in your IRAs. What would even be better is, if, especially since you don't need that income, is do a Roth conversion with that money. Fill up the tax bracket with a Roth conversion, and then after 5 years, that money will never ever be taxed for income again. So fill up that tax bracket. Likely, or in addition to that, if you're in a larger tax bracket, but your taxable income in retirement is going to be a substantial number, 150, 200, maybe 250,000, and you've got real large retirement account balances, I think you'd want to consider the same thing, even if it's in a 28 or even a 33% tax bracket. If you're in that category where you're a high earner and it's likely your taxes are going to go up in the next 5 to 10 years, and instead of being 28, it might be 40 or 50. And remember, it's normal to have our highest income tax brackets be 50% or higher. That's what's more normal if you go back and look at U.S. history. So you might want to consider filling up that tax bracket. So, but the biggest opportunity is in that 15% bracket. So it's called filling up the tax bracket. You should be looking at your taxes every year. That's end of year tax planning in November, which we're right on the cusp of that. And look at those opportunities you can get to fill up that bracket with a lower tax bracket, so that later on in life, when you're in your 70s, you can reduce the effect of the income taxes on your income.
And that's our Dollars and Cents segment for this week. You can find this week's Dollars and Cents segment and others by visiting BroganFinancial.com.